Good afternoon. I'm James Williamson from Netwealth Investments, part of the investor relationships team here at Netwealth, and it's great to be presenting this webinar this afternoon, or hosting this webinar I should say, on how to spot investment opportunities in investment markets, which has been in conjunction with Orbis Investment Advisory and Dr Graeme Shaw, who will be presenting with us. I'll just quickly take you through a few housekeeping items. This webinar is being recorded. The slides will be sent to all people afterwards, along with the any question and answers that you've sent through. We'll get back to you with the answers to those. As it says there, the questions, enter your questions in the chat at the bottom. We'll get to those at the end. And if you want to post to social, please use those handles and the at Netwealth Invest option, and we can hopefully get that trending perhaps this webinar, which would be fantastic. As always, any information presented here today is general advice only. Please seek any personal advice on your specific investment situation from an authorised financial advisor. Today's presenter is Dr Graeme Shaw, a director at Orbis Investment Advisory. Dr Shaw's been with Orbis since 1997. Previous to that, he completed a PhD in the field of chemistry from Cambridge, and he's also a chartered financial analyst. So it's a real pleasure to have him along today to present on how to spot investment opportunities in the emerging markets. Without further ado, I'll hand over to you, Dr Shaw.
Thanks very much, James, and thanks for the opportunity to present. Today I'm going to talk about contrarian investing and why we think emerging markets offer attractive opportunities to contrarian investors today. So I guess a good place to start is explaining what is a contrarian investor. So if you look at the Oxford English Dictionary definition, a contrarian is a person who opposes popular opinion and current practice. I don't know about you, but from my perspective, this doesn't actually make it that much clearer what a contrarian investor is. So let me elaborate a little bit. I guess the first thing we know about contrarians is that human beings aren't natural contrarians. You know, we're social animals. We like to stick to the crowd. And as you can see in this cartoon, we stick to the crowd even if it's not really in our interest to do so. Now, this is life. And in most of the time, you find that it's not a good idea to be contrarian. When we were living on the plains in Africa and someone yelled, you know, run lion, the contrarians got eaten. Even in modern life, most of the time, it's actually not a good idea to be a contrarian. For example, if 99 out of 100 animal trainers tell you, you know, this dog is dangerous, you shouldn't touch it, but one person says, no, don't worry about it, he just wants his teeth cleaned, you know, are you going to get out your toothbrush? I don't think so. In fact, in most other parts of life, it pays to listen to expert opinion. But there are exceptions to that, and it turns out actually investing is one of those exceptions. The reason for this is that stock prices don't move as a result of the outcome of some event. They move according to the difference between what was expected for that event and what actually happened. So for example, if all the experts tell you the earnings for this company are going to be amazing, the company duly delivers amazing earnings, the stock price won't move because what happened equaled what was expected. In contrast, if all the experts say, you know, this company is going to have absolutely dreadful earnings, and the company turns in earnings that are merely bad, the stock price will move up because the outcome was better than expected. And so in some sense, I guess, what investors should be looking for are stocks where the outcomes can be a lot better than what was expected. The question is, how do you find these kind of stocks? Well, I guess in most people's lives and in their jobs, they have an idea about how you do this. And generally, you know, it's well known the way to impress your boss is to under-promise and over-deliver. You promise the report in 5 days, you deliver it in 3, your boss is happy. And the question is, what's the equivalent of this in the stock market? So to understand that, I guess we have to look at how most people invest. So this cartoon shows you how many people invest. The black line is the price of a stock oscillating over time. And what you find is when the stock is moving up and the price is getting quite high, people are getting excited about the company, investors want to join the fund train, they're willing to pay very high prices to get involved with what they consider to be a really exciting opportunity. That excitement causes them to buy when prices are high and to pay high prices. In contrast, if the stock price has been moving down for a long time, people get scared. They're scared of losing money, and they're willing to sell out at low prices in order to mitigate their fears, the fear of failure and the fear of losing money. And so they end up selling at low prices. And as the cartoon suggests, if you continue to buy high and sell low, it doesn't end particularly well over the long term. And this is how contrarian investors invest. It's simply the same as the way everybody else invests, except upside down. So when prices are low and other people are panicking and other people are scared and they're willing to sell to us at low prices, we're happy to come in and buy off them. They'll generally deliver us companies at prices that are less than they're really worth. And in contrast, when everyone's excited and things are going really well for a company and people are willing to pay up high prices to get involved, we're happy to sell to them in order to exit our positions. And so on average, you end up buying low and selling high, which tends to work out a little better in the long term. So, okay, this is all very subjective. What does this look like in practice? So this is the track record for Orbis, the Orbis Global Equity Fund over its history. It's a 27-year-long track record, and you can see the fund in dark blue has done significantly better than the world index in light blue. It's beaten the index by more than 5% per annum. Now, 27 years is quite long, but statistically, it takes somewhere between 15 and 20 years for a good track record to actually cross that threshold where you'd say statistically it's skill and not luck. I guess we can provide you with another piece of evidence that shows contrarian investing really does work, and that comes from our sister company, Allan Gray Limited in South Africa, who've been applying the same philosophy in that market for 40 years, and they've beaten their local stock market by a very similar amount, actually slightly more than Orbis has, over a 40-year period. So you put those two together, that's a fairly convincing piece of history to sort of say we think this style of investing does work. To give you a few examples of the kinds of positions we've taken over time, if you look at the top there, you can see in the early 90s when Japan was in the midst of its own stock market and real estate bubble. This was when Japan had the dominant economic model. Japanese investors were buying up golf courses all over the world. Japan was almost 40% of the MSCI World Index at the time. We had none. We're very comfortable not owning things that are in the midst of a popularity bubble. If you look in the mid-90s, early to mid-90s, we had built up quite a significant position in technology stocks. But by the time we got to the top of the technology bubble in around about 2000, we had sold those tech stocks. We had almost nothing in technology at the time, very similar to the Japan bubble when things are very popular and people are paying crazy prices for things like petfood.com, we tend to stay away. In contrast, if you look in 2008, we'd built up quite a sizable position in Japan, because by then Japan had been in a bear market for 8 years and was very unpopular. The economy was sluggish. No one was very optimistic about Japan, and that actually worked out quite well in 2012 when Abe got elected and introduced his 3 arrows economic policy, and the Japanese stock market responded quite positively to that. If you look more recently, we've built up a position of slightly over a quarter of the fund in emerging markets, and that's really what I want to talk to you about today. Okay, sorry about that. So I guess just to answer the question, what are emerging markets? They're countries, they're stocks listed in countries where they're not quite wealthy enough to be considered developed countries, but they're close. And there's a whole range of criteria that the index providers use to classify a country into developed or emerging. But if you want a rough rule of thumb, a country with a GDP per capita of somewhere between $10,000 and $25,000 will be regarded as being an emerging market country, and the stocks that are domiciled in that country would be considered emerging market stocks. You can see here the countries that are very large in the MSCI Emerging Market Index, which is the dominant emerging market index. include China, Taiwan, Korea, India, Brazil, and South Africa. So that gives you a feel for what people are talking about when they say emerging markets. So now, before I go into the reasons why I think emerging markets are attractive, it's probably worth just recapping on the standard pitch that you'll see for emerging markets, often on websites for emerging market funds. And the pitch looks something like this. First of all, there's the theory part of it, which just says, well, emerging market economies grow more rapidly, and of course, rapid economic growth is meant to be very good for the stock market and therefore good for investors. So that's the theory. The evidence pretty much involves people just looking back at the almost 30-year history of the MSCI Emerging Market Index and saying, well, look, it's beaten developed markets, so the evidence supports the theory. So I'm going to suggest to you today that there are problems both with that theory and with the evidence. So let's deal with the theory first. This graph here shows you the relationship between GDP growth and real equity returns for a range of different country stock markets over a period that lasts well over 100 years. And, when you just look at it, the slope is positive. There appears to be a reasonable relationship between GDP growth and stock market performance. The faster your economy grows, the higher your stock market returns. So far, so good. It seems to fit with the story. Unfortunately, the story starts to unravel when you look at this data set. It's exactly the same data, except this time plotted against GDP per capita growth. And in this case, actually, there is no relationship. In fact, there's a slightly negative relationship between GDP per capita growth and stock market performance. So the one on the left suggests GDP growth is good. The one on the right says GDP per capita is bad. How do you square this circle? Well, the main difference between these two data sets is population growth. So maybe emerging market investors can feel comfortable knowing that it's okay, maybe GDP per capita growth isn't going to save them, but at least they've got population growth to rely on. The problem with that is this data set here. Now this data shows predicted fertility rates over the medium term. The data comes from the CIA, and I guess as we've learned recently, it's probably very accurate because the CIA seems to know everything about everyone's private lives. There's probably two conclusions you can reach when you look at this. The first is that anything that's darker than a light blue color represents a fertility rate below 2.3 births per woman, which is the replacement rate. And so the first thing is much of the world has a fertility rate that's at or slightly below replacement rate. And the second conclusion is if you look at where the big emerging markets are, Brazil, China, Korea, places like that, there is no difference between their fertility rates and that in developed markets. So it doesn't look like population growth is going to be your long-term savior for emerging market investors. The other reason I don't believe the theory is that if you look at that original data set, it's very influenced by the countries in that red circle there. These are countries that have benefited from a huge wave of immigration of what you might call pioneers. Highly motivated working age people who've come to those countries. If you exclude those countries from the data set, it looks like that. Much less strong relationship between GDP growth and stock market performance. The other reason I doubt the theory is that when you look in emerging markets, okay, this is a fairly recent 20-year period, there is no relationship between GDP growth and real stock market returns. And China serves as a perfect example of this. It's had absolutely phenomenal GDP growth, but it's been quite a disappointing place for investors. So that's why I don't believe the theory. I'm also a little suspicious of the evidence. So one of the problems with emerging markets is it's a fairly new concept. It's been around for a little bit over 30 years, and 30 years isn't really that long in the history of the stock market. But fairly recently, a group of academics from the London School of Economics came up with a way of producing an emerging market index that went back over 100 years. And they did this by using a GDP per capita cutoff to classify countries going backwards in time into developed and emerging. And when you look at the performance of this index over the full 100-year plus history, you find it actually performs slightly worse than developed markets. And so you're in this sort of dilemma now where you look at modern history and you go, well, in modern history, emerging markets have outperformed, but in the full over 100-year history, they've underperformed. Which one is right? Should I permanently have emerging markets in my portfolio, or should I not have them in my portfolio? I would suggest, relying on these sort of generalizations as a way of building your portfolio is not the best thing to do. And in fact, you should just treat emerging markets just like any other investment. Own it when it's out of favor and cheap. If it's not out of favor and cheap, go and look elsewhere to invest your money. The good news in this regard is that emerging markets are really starting to look quite cheap today. So this graph here shows you a plot of the MSCI Emerging Market Index versus developed markets. And you can see over the last 5 or 6 years it's underperformed significantly. In fact, it's underperformed by more than 50% since its peak. And the funny thing about that peak is if you go back, that was the time where people came up with the acronym BRICS for Brazil, Russia, India, China, and South Africa. And maybe one of those lessons of history is that if something's done very well and someone invents an acronym for it, investors should be a little bit wary. It's not just prices that look low in emerging markets, it's also PE multiples. So this graph shows you the PE multiple for US stocks sort of in orange, developed markets in blue, and emerging markets in green. And I guess the thing you see is that while the PE multiples in developed markets have risen quite significantly over the last 4 or 5 years, emerging markets have been fairly flat. And you buy them today for around about 14 times earnings compared to 21 and 23 for those other two lines. So that's encouraging. The other thing that's encouraging is if you look at the gap in PE between emerging markets and developed markets, you can see it's unusually high today and much higher than it's been for much of the last 15 or 20 years. Emerging markets also look cheap on price to book. So the dark blue line at the bottom on this chart shows you the price to book of emerging markets relative to developed markets. And you can sort of see, they're not as low as they've ever been in the history of this chart, but they're certainly near the bottom of the range. You buy emerging markets today at a 30% discount to developed markets on price to book. And that's despite the fact that emerging market ROEs have been very similar to those in developed markets. So that light blue line at the top there on the right-hand scale shows you the emerging market ROE minus the developed market ROE back over time. And you can kind of see it fluctuates around about 0. Both markets produce similar average ROEs and therefore you could argue deserve similar price-to-book ratios. The other thing that's encouraging about emerging markets is that the spread in valuations are quite wide. So far I've been discussing index level valuations, but of course as investors you don't have to just own the indices. You can actually own the cheaper parts of the attractive markets. And so on this chart, anything close to the bottom left-hand corner looks cheap, and anything close to the top right-hand corner looks less cheap or more expensive. And it's probably not surprising from this chart that we find a lot of attractive ideas in places like Russia and Korea, and to some degree China. You can do a slightly different analysis to this. You can actually forget all the countries and just look at stock valuations on a company-by-company basis and look at the valuation gap between the cheaper companies and the more expensive companies over time. And if you do that analysis, you also find a similar conclusion. Spreads and valuations within emerging markets are quite a lot wider than they have been for 15 years. And that's attractive to stock pickers like ourselves. Now, whenever you see an opportunity in the market to buy something cheaply, it's always worth stopping and asking, well, why does the market allow that to persist? What is putting people off taking advantage of these cheap valuations in emerging markets? And I think if you look, there's sort of 2 commonly quoted reasons why investors haven't gone for these opportunities. The first fear that people have is that rising US interest rates is bad for emerging market relative performance. I find this a slightly curious fear because when you look at history, it really doesn't support this idea. So we've tried to show this in the chart here. So the dark blue line shows you the relative performance of emerging markets versus developed markets over time, and the light blue line shows you US short-term interest rates. And there have really been 4 periods in history, which are shaded in grey, where US short-term interest rates have risen quite steeply. The red arrows at the top there show you how emerging markets have gone relative to developed markets. So in the first period, emerging markets outperformed a little bit. In the second, they underperformed a little bit. In the third, it was a tie. And in the fourth, emerging markets outperformed a lot. And so I would look at that and go, geez, it doesn't look like big changes in US interest rates really have any relationship between emerging market relative performance. And in fact, if you force the data to give you a conclusion, the conclusion would be, well, actually rising US interest rates is marginally good for emerging market relative performance. And you reach a very similar conclusion if you look at all interest rate changes. So another analysis we did is just looked at the correlation between the 2-year changes in interest rates and the 2-year relative performance of emerging markets. And you find the correlation between those two variables is very low. It appears when you look back at history, US interest rates really don't matter very much when it comes to the issue of emerging market relative performance. The second fear people have is that they think, wow, geez, okay, equity valuations are pretty high. It means there's probably an above average chance of a bear market from this point in the cycle. And I don't want to be exposed to things like emerging markets if there's going to be a bear market. So I have some sympathy with this fear. It is true, valuations of developed markets are higher than average. It is also true that valuations of most asset classes are above average. I mean, bond yields are well below long-term averages, credit spreads are well below averages, property in many Anglo-Saxon markets is very high. And you do have to invest your money somewhere. So yes, developed markets are high and maybe the chance for a bear market is above average. But the question is, does a bear market in developed equities impact the relative performance of emerging markets? Well, history can answer that question too. You can go back and find periods of history where emerging markets had already underperformed a lot. And remember, they've underperformed by 50% at this point in time. So go back and find periods of history where emerging markets had previously underperformed a lot, and then there was a bear market in developed equities. And there's 3 of those periods in history, which are shown here. When you look at the period where the developed market bear market occurred, what you find is developed markets underperformed twice, and then they tied with emerging markets once. So again, on this fear, it looks like history says there's really nothing to worry about. There's no reason to believe at this point in the cycle that emerging markets are going to underperform if there's a bear market in developed equities. So I guess that's the more academic background to why we believe emerging markets are attractive. I want to talk through a couple of examples just so you can see how this works in practice. And the first example I'm not going to talk about is Tesla. I put Tesla in here because it represents one of those companies where I would regard investors' expectations as being very high. If you look at Tesla today, I mean, they make wonderful cars, but they have the same market capitalization as BMW. BMW sell 2 million cars a year, and in addition another 300,000 odd minis, including 30,000 electric vehicles. Tesla today aim to sell about 100,000 cars. So you're paying the same market cap for a company that sells only 5% of the cars of BMW. Essentially what investors are saying is that Tesla can grow to be at least the size of BMW. Now, I'm not saying they can't do that or that that's impossible. I'm just saying that's a very high expectation for the company to be able to meet. The company I'm going to talk about today is Samsung SDI. Now, Samsung SDI has a similar exposure to the electric vehicle theme as Tesla, but without very high expectations. Now, many of you probably haven't heard of Samsung SDI. This might refresh your memory. This is a Galaxy S7 phone which caught fire because its batteries overheated, and Samsung SDI were the manufacturers of those batteries. As you can imagine, this kind of event isn't thought of kindly in the stock market, and the share price of Samsung SDI fell significantly to the point where it became interesting to contrarians like ourselves. So of course when we look at this company, the first thing we have to make a decision on is, was this just a one-off blip, or is this reflective of the poor quality of the company? When you look at the evidence involved here, it appears to be quite a complex issue. So there was one other manufacturer who also had battery overheating problems with this phone. So it's not just Samsung SDI. And then Samsung Electronics, who are the maker of the phone, are not taking legal action against Samsung SDI, which suggests it's probably a complex interaction between design flaws in the phone and design flaws in the battery. Samsung SDI have actually redesigned this battery to eliminate this flaw and maintain very good relationships with their customers. So we think this is more a one-off blip rather than a reflection of the company itself. And so we can come back to that electric vehicle theme. So this chart shows you a picture of the development of the electric vehicle market. You can see that from the blue line there, they've grown over time and represent about 1% of global vehicle sales today. If you look at the market's expectation for electric vehicle sales going forward, it's probably fairly consistent with an extrapolation of the historical trend so far. Now we think there's a couple of data points that suggest this might actually go faster than people think. The first data point is Norway. The numbers in those yellow circles there show you the electric vehicle share of the vehicle market in Norway. And you can see electric vehicles represent almost 30% of the market in Norway, up from 6% only a few years ago. And the question is, how was it possible for electric vehicles to gain share so quickly? And the answer to that is that Norway subsidised electric vehicles. And if you look at the pricing of electric vehicles in Norway, they're very much on par with conventional vehicles. So it turns out, once prices are similar, consumers have quite a strong preference for owning electric vehicles. The second data point comes from a company called Continental. They're a large global car parts manufacturer. They have a very good understanding of the dynamics in the car market. And this was their forecast for electric vehicle sales that they made in 2014. You can see in 2025 a tiny little slither of orange there representing about 1 million cars. So you can sort of see Continental weren't expecting things to develop very quickly. But they've revised their forecast really only 2.5 years later, and they're now expecting 11 million vehicles in 2025. That forecast has gone up by a factor of 11. And that's really quite a rapid change in their forecast over such a short period of time. So those two data points give us some feeling that maybe electric vehicles could surprise on the upside. Now if you delve into the details of how the batteries for these cars are made, there's really sort of three designs. There's a cylindrical design, and basically the way these are made is you take the anode, a separator, and the cathode, you fill the gaps with gel, including lithium ions, you roll them up, you stack them in a box, and you wire them together. There's more advanced designs, prismatic and pouch batteries, which have a few advantages. First of all, the chemical matrix they use in these batteries is more stable, so you can charge them more frequently, typically twice as often as you can charge a cylindrical battery. And they're also stacked into rectangular shapes, so they use space more efficiently. It's harder to stack cylinders than it is to stack rectangular boxes, and so they're more space efficient. But they are slightly harder to manufacture, and they are slightly more expensive. But if you work out their cost per charging cycle, they're actually cheaper than cylindrical batteries. So these are the people that make these batteries. Panasonic and their partner Tesla make cylindrical batteries, so they're the cheaper ones that can't be charged quite as often. And you can see the two Korean makers make the prismatic and pouch batteries, both of whom have very credible auto partners who are using their products. So this is technology that is being used today. Now if you think about how many batteries the world is going to need, one way to get at it is to add up the capacity the industry has for producing batteries, and this is what we've done up to 2020. So the world will be able to produce at the moment roughly 240 gigawatt hours of power, which is enough to make 5 million car batteries. And the question is 5 million batteries enough? When you look at those forecasts and you look at Norway's experience, maybe 5 million will be enough. Maybe the demand will be a lot higher than that, which of course will be a big benefit to the battery manufacturers. The nice thing about Samsung SDI is that you haven't had to pay a high price to get this exposure. So if you look at the valuation, Samsung SDI is comprised of cash and investments. The chemicals business, it's a fairly standard chemicals business without high barriers to entry. We value that at book value. It has a stake in Samsung Display. Now Samsung Display make these high-end wraparound OLED displays that you will have seen on Samsung phones, and indeed it looks like Apple is about to buy its displays from Samsung Display. So, it's a good business, reasonable barriers to entry. We valued that at somewhere between book value and 15 times earnings. So book value is the middle of that rectangle, 15 times is the other end. And then there's the battery business. Now, it's very hard to know what the battery business is worth. Much of the value is distant in time. And so this is a bit of a guess. We've used a discounted cash flow model to make this guess. But the key thing about Samsung SDI is when you look at the price. So at the end of April, you paid $8 billion for the company. In other words, you were paying for the cash, the chemicals business, and a very conservative valuation on the display business. You got some of the display business for free and the entire battery business for free. And this is what I'm talking about when I say low expectations. If Samsung SDI make a good job of the battery business, it's fantastic. If they don't, you haven't really paid for it. Unlike Tesla, you're not assuming any success when you buy this company from their efforts in batteries. So that's one company where I would argue the share price is really underpromising, and therefore you have a higher chance of over-delivering. The second example I want to talk about today is Sberbank, which is Russia's largest bank. Now, we became interested in Sberbank shortly after this photo was taken. These apparently are friendly Russian patriots who in their spare time chose to stand guard outside a Ukrainian naval base in Crimea. Shortly after this, Russia annexed Crimea and the West imposed sanctions, which obviously are not good for the Russian economy, and it's not surprising that share prices in Russia fell quite significantly. Now, this graph shows you both the price of Sberbank over time and the number of shares that we held in the company in grey. You can see in that sort of first circle during the Crimean crisis, the price fell quite significantly. We used that opportunity where investors were panicking to build our position. Unfortunately, shortly after that, we entered a period where the oil price was extremely weak, and the Russian economy is very dependent on oil. If the oil price is weak, investors start to worry, business activity will decline, and maybe people will start defaulting on their loans from the bank. And so you can see Sberbank's share price was quite a lot weaker than the level we bought at. This is actually not uncommon for a contrarian investment. Just after we buy it, it doesn't necessarily mean the stock price is going to jump back to normal. Quite often it continues to get weaker. And a key part of being able to invest this way is to being able to hold your nerve throughout that period of stress, which we pretty much managed to do. And then you can see from the rest of the chart, the price recovered and we slightly reduced our holding. Now, you're probably wondering why I'm talking to you about this. It looks a bit like yesterday's story. But we think Sberbank is still very attractive today. And one of the reasons we find it attractive is that it's an extraordinarily dominant bank in the market it operates in. So if you look, for example, they have nearly 50% of retail deposits, and they earn 60% of the profits of the entire banking system. Banking is a scale game, so as you get bigger, you get more profitable. And Sberbank is so much bigger than its competition, it effectively sucks up most of the profits. You can see that on the right-hand side. The average ROE, or the return on equity capital for Sberbank, is triple the levels its competitors achieve. So it's extraordinarily dominant. And this dominance has allowed it to weather tough times very well. So this chart shows you the oil price, which is the dark bars at the back, and the growth rate in the Russian economy, which is the blue line, and then the return on equity for Sberbank. And there have really been two stressful points in the company's history. The first one on the left is the global financial crisis, where you can see the Russian economy shrank really quite significantly. It clearly impacted Sberbank's profits because the red line falls, but at a minimum, it was achieving a 4% ROE. This is not too bad for a bank in the midst of the global financial crisis. If you look at many Western banks, they made colossal losses over this period and raised huge amounts of capital, diluting their investors. Sberbank actually came through that crisis perfectly well, despite the weak economy it was operating in. Then the second crisis is the Ukrainian crisis and the oil crisis mixed together. Again, you see from the blue line, the Russian economy shrank over this period, the oil price has been low, and Sberbank's ROE did fall, but only to a minimum of 10%. So again, a remarkably robust result. This shows you the fundamental history for Sberbank over time. So the orange line there is earnings times 10, the blue line is dividends times 10, and those bars at the back there represent book value, so that's the bank's capital. Now the way banks grow over time is essentially they take the earnings they got last year, they'll pay some of them out as dividends, the rest of the earnings they retain, and they can use those earnings to make new loans to customers. Because Spurbank is so profitable, its retained earnings are quite significant, and that has meant the bank can grow its loans rapidly. So if you measure its growth in earnings or capital over time, it's typically grown at around about 20% per annum. Our view is the bank can continue to grow at this rate for quite some time. For example, in Russia, if you look, the level of debt relative to GDP is low, both compared to other emerging markets and compared to developed markets. So there is plenty of room for customers in Russia to take on more debt. The remarkable thing about Spurbank today is despite that 20% growth rate, you only pay 5.5 times earnings for the company and slightly over 1 times its net assets, which is a remarkably low price for such a dominant bank. The final kicker is that sanctions actually haven't been lifted and oil prices have not really recovered. And so Spurbank can do perfectly well if neither of those things happen, but if they occur, that's an additional bonus that will help shareholders. So in conclusion, I guess our view is contrarian approach to investing has worked over long periods of time, both globally and in South Africa. The common reason people give you for wanting to own emerging markets, we would suggest, is not the right reason to own them. Don't own them just because you think GDP growth is being good. Treat them like any other investment. Own them when they look cheap and out of favour, and own something else if that's not the case. On standard valuation metrics, emerging markets look cheap both on price to book and PE. They've achieved a very similar ROE to developed markets, therefore they don't really deserve a big price to book discount. And the other thing that's attractive about them is that valuation spreads within those markets are high, meaning that if you buy the cheaper parts of emerging markets, you're really getting stocks at very low prices. The final thing would be, if there's 2 examples there, Samsung SDI and Spurbank, which show the kind of valuations available to investors in emerging markets today. Thank you very much.
Thanks, Dr. Shaw. That was a very illuminating presentation. I'll just get some questions together that have been sent through. So if you have any further queries or questions, type them in the box in the bottom of the screen. And we'll see if we can't get to them throughout the next 10 or 15 minutes or so, but it was quite interesting just looking at the charts on economic growth and the relationship between stock market performance. But one of the questions that I sort of thought of, or springs to mind, I guess you could say, Dr. Shaw, is when you're investing in emerging markets, how do you manage the risk of inflation or hyperinflation, which is often a problem in emerging markets, such as Argentina, or a more extreme example would be Zimbabwe, which you probably don't go near Zimbabwe, but how do you manage those instances of inflation?
Yeah, I mean, certainly historically, when people invested in emerging market stocks, they had to take the currency exposure as well. Things have got quite a lot better now. Most of the large markets within the emerging market index, it's very possible to hedge the currency. So if you want to own Spurbank but don't want to be exposed to Russian rubles, you can hedge out that currency exposure. And typically the way we would approach that is when you're investing in a stock, you can calculate what you think the rate of return will be. You should subtract the risk-free rate, which effectively assumes you're hedging it, and then look at the difference between your expected return and the risk-free rate as a measure of how much outperformance or how much return you're going to get if you hedge it. Okay. You don't always have to hedge, but you certainly have that option.
Okay. So hedging is sort of a main mitigator of risk. Yeah.
Yep.
And another question that's just come in from one of our listeners is on the similar vein, that when you're investing in emerging companies such as in Russia or somewhere like that, how do you get a clear and true view of the financials of the company, and they're not gilding the lily, I guess, to say?
Yeah. No, it's a good question. I mean, the reality is in most parts of the world, there are incentives for management to overstate what they earn. You know, the management often have shares or they have stock options. If they make the profits look a little bit higher, it improves their job security. So misleading accounts is something you have to be aware of everywhere in the world. It's probably fair to say you should have an increased heightened skepticism in emerging markets, and it's always a big part of any analysis. And so there are various ways you can get at it. For example, if a company tells you that it's been very profitable and it hasn't paid dividends, then you need to check that it really does have cash. And so cash in the bank is a very easy thing to audit, even in emerging markets. And so that's one of the things you would look for. You've got to be aware of things like heavy accruals in emerging markets. So I guess a more focus on cash earnings as opposed to accounting earnings is probably one of the things that you can check. The other thing you can check for is you can track the management's historical track record. So, you know, what were they like at this company? What were they like at previous companies? M&A is a common way for people to destroy value in companies. Yep. So you can go back and look at previous M&A related deals and go, you know, were these deals done in the interest of shareholders or were they done in the interest of somebody else?
Okay. I imagine, yeah, that would be quite interesting looking through the financials of some of those smaller companies. Another query that's come through is just on, I guess, the MSCI categorisation there and putting Korea as an emerging market. Would that be the biggest country, I guess, in terms of per capita that's still classified as emerging?
Yeah, I think Korea is clearly on the borderline. And actually, they had a review recently and didn't get promoted. And, you know, one could speculate why that might be. But, you know, having such a large chunk of the emerging market index move to the developed market might have been one reason why the index providers thought they'd just wait until it was slightly clearer before they moved Korea. You can also go the other way, actually. I mean, Greece has been demoted from developed to emerging, so you can go the other way as well.
Okay, yeah, interesting. Okay, so another query that's come through, I guess, is more generally about the Australian market is what's your take on valuations in the Australian market at the moment?
Yeah, I mean, not dissimilar to developed markets overall. You know, at large asset class levels, everything does look quite high. You know, I mean, if you look, for example, government bond yields, they're typically in the range of 2 to 3%, despite the fact that, you know, 100-year data on inflation across the OECD suggests inflation's about 3. If you look at it since the gold standard, it's been closer to 5. So buying a long-dated government bond yielding 2 or 3, you're really taking the bet that inflation is not going to return to its long-term average. Credit spreads are low. Housing prices are high in many parts of the world, and stocks are also high at an index level. So if you believe asset allocation is the most important thing to investors, it is a rather depressing picture. We would argue that if you delve down to lower levels than those big asset class levels, there are plenty of places you can find where there's compelling value. And, you know, examples would be Russia 2 years ago in the midst of the oil crisis, Brazil 12 months ago in the midst of its political crisis, Korea today, its economy has grown slowly. They haven't stimulated heavily post-GFC. Okay. And you can find well-run companies there at really quite attractive valuations. So there are always going to be pockets. It's a very big world where you can find value.
Okay, interesting, yeah. And what do you and your team at Orbis perceive as some of the bigger risks to equity returns in the near term?
So I guess when valuations, there's two risks. If you take the US market, it's a good example. PEs are historically quite high. But the other thing is the margins supporting those earnings are quite high. Okay. And margins are, you know, historically quite mean reverting. So, you know, companies with low margins, they tend to recover. Companies with high margins, they tend to go back to normal as well. And so that would be a risk. And if you take a model like, for example, the Schiller PE model for the US market, it tends to forecast negative real returns for the US market over the next 5 years because it implicitly assumes margins revert to normal. We think that's probably a little bit pessimistic, and the reason for that is that the composition of the index today is not the same as it was 10 years ago or 20 years ago. And there are some big companies in that index that are operating business models that simply didn't exist 10 or 20 years ago. And so actually we did a slightly different analysis. We took all the companies that were around in the early 90s and are still around today, and so said, how do their margins today compare to their margins in the early 90s? And the result of that calculation suggests, okay, the general conclusion is still right. 50% of companies have margins today that are well above the levels they had in the early 90s. But that still leaves 30% whose margins are about the same and 20% whose margins are well below the early 90s. And so if you look within the US market, there are plenty of companies. I mean, if you argue there's roughly 3,000 stocks in the US you can buy, 20%, that gives you 600 companies to hunt through whose margins are well below average. You only need to find 20 of those for a portfolio. So there is plenty to choose from in the US, even though its stock market looks expensive.
Yeah, okay. And what is your take at Orbis on political movements have been getting a lot of play in the general media, the mainstream media, and rise and fall of extreme parties. Seen a couple of elections recently with some surprise results in France and the UK. What is your take on the sort of the global political situation at the moment?
Yeah, that's a good question. I mean, if you look at the way the world has moved in the last sort of 15 years, it's been wonderful for companies. It's not been so good for workers. If you look at corporate in the US, for example, corporate earnings as a percentage of GDP are roughly double the long-term average. Companies' profits as a share of the total GDP pie is bigger than it used to be. And the question is, why haven't workers responded to this by saying, this is not fair, we want our share to come back to normal? Now, you could speculate that the remarkable political success of Jeremy Corbyn in the UK and even the Democratic primary elections in the US suggests maybe there is a move towards those more left-wing policies. So that would probably be a risk to corporate profits overall.
Okay.
But again, by the time you're down to owning 50 cheap stocks from around the world, their profits often depend on very company-specific things. The political background is a C, and it makes things a little bit better, a little bit worse than they'd otherwise be. But generally, for every stock we own, there's some very company-specific factor that's caused us to pick that.
Okay.
And so, politics isn't that important in this kind of things.
So the politics is, I guess, interesting to discuss, but ultimately you focus on the fundamentals when you're picking stocks largely.
And things we feel that we can predict. Like, can Samsung SDI make batteries properly? Yes or no?
Okay.
Those types of questions, they're much more answerable.
I see, yeah. Another question that's come through is, what is some of the other good performing stocks that you've still own or held recently in the portfolio of the global fund that you mentioned earlier? What are some of the sort of the key stocks, without giving away all your secrets?
So there's a few positions we've built recently. One is in the US health insurers, actually. That represents about 5% of the portfolio. The largest company is a company called Anthem. And if you look at the history of the US health insurance industry, there's two things you can conclude from it. One, the health system in the US will not operate without the health insurers. You cannot remove them from that system. They're key. They typically manage the relationships with hundreds of thousands of employers and multiple health suppliers. So it's not like life insurance where you raise some capital, get a license, off you go. It's actually very hard to become a health insurer in the US. So they're actually a higher quality company because it's harder to replace them.
Okay.
The other thing you find about their history is that their underwriting margins have been quite cyclical. And if you look at an operating level, that sort of varies between 1 and 4%. So if you look at them today, they're earning roughly 1. And if that can recover back to normal, they'll go to 2. So in some sense, the underwriting profits can double. and their PE today is around about 12 or 13 times earnings. So you pay a well below market PE for a company whose operating results are significantly below average.
Okay. So is that in response to, again, the mainstream media and the new president of America has been talking about restructuring that public healthcare system to somewhat? Are they under pressure due to that?
That may have put some people off, but interestingly, the industry's always been cyclical. So when there's a lot of capital chasing returns, it tends to depress their margins. After a period of low margins and low returns, the capital leaves and goes looks somewhere else, and margins recover. Okay. So there's probably a 30-year history where you can see how cyclical. It's always been a cyclical industry.
Okay, interesting. Yeah. So again, I guess you're looking at the fundamentals of the companies there rather than taking a view on
the political outcome with Donald Trump and the healthcare system. Absolutely. Who knows what will happen?
Yeah. And going over to the other side of the Atlantic, what's your take on the stocks in continental Europe, there, such as France and Germany? Do you have much of an exposure to stocks in those larger European countries?
It's interesting. If we had to only own indices, we had to own only stock market indices, what would our portfolio look like? It would probably be very heavily invested in Asia. Mm-hmm. We would have quite a lot in Europe. We'd probably have nothing in the US. Mm-hmm. But when you look at our actual portfolio...
Sorry, just to jump in, why would that be?
Just because at an index level, the US market looks quite a lot more expensive than things like the French index or the German index.
I see.
Probably profits have also run harder in the US than they have in Europe. Okay. So that's probably why we prefer Europe over the US. But actually, when we're not owning indices, we're looking for 50 stocks out of 5,000. So 1 in 100 stocks. Mm. That actually, when you look at that cheaper end of the spectrum and just say, what can I find at that end of the spectrum, we actually find a lot of those stocks happen to be US companies. I think one of the reasons for that is simply there's just a lot of US companies to start with. Yeah. And so, if even only 5% of them become cheap, that's still a lot of stocks to pick through.
Stocks, yeah.
And so, yes, things like Anthem would be a good example of things we've found fairly recently. You look at the market and you go, geez, it's amazing you found a stock that cheap in the US. But yeah. There's actually quite a few of them.
Okay. Yeah, so you, again, looking through those stocks and just finding the best opportunities there. So that's quite interesting, I guess, to investors and our listeners specifically. There's another query has just come through again, sort of bringing back to the Australian market. Is there any sort of couple of 2 to 3 risks that you see specifically to the returns of the Australian stock market?
Yeah, the most obvious one is the banking sector. Generally, when you see the financial sector profits become a large part of GDP, that's a warning sign to investors. And if you look pre-GFC in the US, that's exactly what you saw. Banking profits as a percentage of the total company profit pool grew to be quite large. And we were very underweight banks at that time for exactly that reason. It wasn't that the PEs looked crazy, but the profits looked very high versus trend and had been going up for such a long time that you worry something can go wrong. And if you look at Australia, it's actually remarkably similar. Debt has been growing rapidly in Australia for a very long time. And in fact, the banks can be disappointing even if there isn't a housing market crash. Even if house prices just go sideways from here, the banks won't do that well because their loans will stop growing, but of course their costs will keep going up with inflation. And so just operationally they start to get squeezed. They won't be terrible. Yeah. They'll be okay investments, but they won't be great. Yeah. And then of course you do run the risk that actually the housing market returns to normal. And in fact we've got very long data sets on housing. So we've got a 400-year data set on house prices in Amsterdam. Perfectly successful Western city. If you look at real house prices in Amsterdam over 400 years, they don't go anywhere. The long-term data says house prices don't go up faster than inflation. We've got almost 200 years of data from Australia and from the US. And if you exclude the last 20 years, your conclusion would be very similar. House prices only go up with inflation.
Okay.
The last 20 years has been very unusual, and you sort of see the US went up a lot, and then of course the GFC, they came down. Australia's house prices have continued to go up. So you'd have to say what we've experienced in the housing market here in the last 20 years is extraordinarily unusual in the context of history.
Okay.
And probably just reflects the fact that interest rates are extraordinarily low,
Yep.
and people have used that to take on way too much debt.
Yep. Okay. So the housing market is your chief risk to the Australian market.
It's a big risk.
Yeah. Okay. Well, I think we've answered everyone's questions that have come through there, Dr. Shaw. So again, thank you for making time to come in this afternoon and present. Hopefully our listeners found that useful. I know I certainly found it quite intriguing to hear you discuss the scenarios when investing into emerging markets. So if anyone is interested in investing into the Orbis funds or fund that invests in the global markets, that's available on the Netwealth platform in our superannuation product and our non-superannuation product. You can see that on the Compare Managed Funds menu on our website, or contact Netwealth from one of the forms on our, again, netwealth.com.au website, and someone will be in touch with you to take you through that in more detail. The slides will be sent out to everyone in the next few days, so you can go through them at your leisure, and the recording will also be there as well. Look forward to next time. Next month we'll have another presenter in that we'll notify everyone of soon enough, but thank you for joining us this afternoon. Thanks, Dr. Shaw.
Thanks, James. Thank you.